so it's Friday, October 13th, or Friday, November 13th. And we are 9 days post-election, so there's some things we want to talk about. Where we are with this is historically, excuse me, historically, as I pointed out before, about 76% of the time, the stock market does better, but improves between election and the end of the year. And so far, that's proven true this year. We are up quite a bit since November the 3rd. The other part is that historically, over the last 70 years, the best stock market periods, 4-year periods, happen to be when there was a Democrat president and a Republican House or Senate. So this is setting up. It's not as bad as I've got some people that are concerned, but generally, if you look at history, a Democrat president and then countered by Republican House tends to be the best conditions for the stock market. So that's where we are with that. Over the last, since 1952, the number of Republican versus Democrats has been about even, 7 Republicans versus 6 Democrats. And rarely does it go more than, you typically have, the longest it's ever gone is 12 years as a Republican president, and that was Reagan Bush. Everything else is pretty much tops out at 8 years, and then it typically flips parties. And that's pretty standard. So this is not that big of a surprise on where we are. And now it's a matter of policies being set forth, where we're going to go, and maybe some fine adjustments to sector allocations. But so far, what we see in the market has been pretty positive. So Mallory's helping me again this week, and let's go to the first chart, Mallory, if we could. And she's going to come up here in a second. And there we go. So I've added the blue line over on the right-hand side, that vertical line. That is the election day. So you can see that we had that decline. Recall that over the last couple of months, I've said that I thought we would see a decline in October, November. That decline that you see there right before the election, that's not quite what I'm talking about. I was talking about, my expectations were something a little more severe. But the point here is that from the election, which is the vertical blue line, forward, we've got everything is moving up. And that's obviously a good sign. It's moving up a little faster than I'm comfortable with. I like things to be a little bit more, not flat, but certainly not dramatic. And we'll talk about volatility in a second. So you can see what we've done since the election, and we are now essentially, stock market wise, we're recovered from the COVID crisis back in March. So you can see back on March 23rd, where we had that huge dip. We are now 6, 7, 8 months past, and the market itself, general broad market, is recovered. In a second, we'll talk about world markets that haven't recovered, but the U.S. has done okay. So Mallory, go to the second one, please. This is that chart I was talking about, where we've had since 1952, 7 Republican presidents, 6 Democrats. The longest any party held was 12 years. And then the S&P 500, which is another index we use, and that's more of a broad look. This is how the market, the S&P 500 performed in the first 952 days, which is essentially, 3 years, trading days. The best was under Clinton, where it was up 62%. I'm sorry, the best was under Obama, where it was up 75%. And then Clinton, and then H.W. Bush, and then Trump, and then Reagan, and then George Bush. George Bush was saddled with a couple of things, and I always want to put an asterisk on there. He was the first president to actually have to deal with, in modern times, to attack on our country and our land. And so that was kind of a bad deck of cards. But you can see that Democrats have done pretty well. So I don't think it's time to panic at all. And I know there's a lot of folks that think that way. But generally, as long as we can keep some Republican interest to offset that, we'll be okay. So Mallory, go to the next one, please. The volatility index did not come over. So let me talk about it a little bit. What you would see here is 0 being right there in the middle. And then you would see that back here in March, the volatility index was way up and down. It went as high as, positive about 1.15 and down to a negative about a 0.15. So what's happened is as it's gone toward when it starts hitting July and then moving through, that line becomes flat. And we'll drop this in again next week so you can see it. But what it shows is that the volatility index, which 3 weeks ago was at 40, is now down to 24.11. And so it shows that things are kind of stable. And I wanted to show that today, that what we're seeing is we saw a lot of volatility in March, a lot of uncertainty, but the election over, it's really become stable. So we'll redo that one next week. Mallory, go to the next one. This is the Dow Jones change as a percentage. So you can see again back in March where we had these dramatic, huge numbers every day, and these are percentages. So this is a percentage change, not a points change. And so you can see back in March with these massive changes, and those changes have kind of stabilized over the last couple of months, certainly over the past 3 months, to where now we're talking about a change every day of less than 0.5% up or down. And that's a reasonable thing to expect. So while these numbers look kind of heavy and dramatic and a lot of movement, it really isn't. So it's nice to see that, and that reflects back on the volatility index, where you're seeing some of the numbers you're going to go up and down. The market's going to fluctuate, but overall, it tends to want to go and climb up. We've talked before, back in March of 2009, the Dow Jones average was at 6,600, and it closed last night at 29,000. So to go 12 years and go from 6,600 to 29,000 is a pretty phenomenal accomplishment. So anyway, what we're seeing here is a percentage change is dropping, and that's good to see that. Mallory, let's go to the next one. And this is world markets, and as you can see, if you look down at that column, the second one from the right, where you show the Japan Nikkei, they've all had a pretty good week. And unfortunately, we've had a technical issue where our numbers didn't transfer in from last night, but all of the indices this week were up. Everybody had a positive week. Everybody went up. The only indices that are positive for 2020 year to date are the US, the Dow Jones, the NASDAQ, and the S&P 500. Those are all positive right now. So that's good to see. The countries struggling the most are Singapore, which is Asia, and then the United Kingdom. So they're struggling a little bit, and the one that's least is Germany. So this year's abnormal in that what's happened, but I think when we get to 12/31, December the 1st, we're going to find that the year ended up being semi-normal. It could have been a whole lot worse. So we're seeing some strength come back into the markets worldwide, and if we can hold that, that'll be great. And some of that's going to swing on our ability to transfer power and do it smoothly, because as the US goes, so does a lot of the world. And so we'll be watching that too. Next, this is our, fortunately I put in the green here. The bright green is the highest performer, and then the middle green is the second performer, and then the light green is the third. So you can see that the only sector that's done really well since January 1st, when you talk January 1st to March 24th, and March 24th to today, and 2001 year to date, is telecom. And then the others have kind of bounced around a little bit. So it shows you that when you're doing sectors, it's not really a good idea to play one or the other. I recall when I first got in this business, someone pointed out that if we'd invested in Swiss Energy the year before, we'd all been wealthy, but nobody would have guessed Swiss Energy would have been the strongest micro sector. So you can see, I'm glad I put these green boxes in here. It's kind of bounced around on who's done the best. And Mallory, the next one, please. This is unemployment rate, and those numbers continue to decline. As we talked about, we expect unemployment to drop below 5% in 2021, and it's starting to whittle away. Our 12-month moving averages continues to drop. We were down to 757,000 filings a week ago yesterday. So that's a good sign that things are coming back. And again, what we've talked about is my concerns as we head into the winter months, what jobs we're able to maintain and where we go. Now, that gives me an opportunity to touch on the FOMC comments this week. the comments basically were confirming what we've already done. The United States sometimes in the past has had to change how they're structured. So we went from an industrial society to a service society, and so things are going to change. And as the chairman brought out, we're going to see some sectors recover better than others. We're going to see some sectors may not ever recover, but we're going to see a change in the U.S. economic outlook, the U.S. GDP, what it's comprised of. And so we're going to start to see some movement in employment on where it's going to go. Are we going to see service sector employment? We will probably see less. We're going to see companies adapt to COVID. We're going to see some companies find out that they don't want to go back to what they were doing. One of the biggest possibilities is we're going to see a lot of companies that decide they don't need brick and mortar to run their companies anymore. They can have their employees work remotely. There's enough safeguards in there to allow that. So that may be the biggest opportunity going forward, is where people are looking for real estate. They're looking for short-term leases for offices because they need to downsize, and they don't really need the 500 desks. What they need is 200 desks and people rotating, coming in 1 or 2 days a week. So there's a lot of things to think about as we go forward, how this has caused the mentality of business and what they may want to change in their business model and how they take it forward. And we'll see that evolve. It's going to be slow, but we'll see it evolve between now and say the next 24 to 36 months as companies decide what they do and do not want to adapt and keep in place that they've had in place the last 7 or 8 months. Treasury yields, we continue to see that spread get bigger. As of right now, the 10-year Treasury is of 0.88, which is not great, but the 2 years of 0.175, again, not great. But my issue is that I always want people to be rewarded for investing longer. Would it be wise to buy a 10-year Treasury right now? No, it wouldn't, because it's highly unlikely it's going to stay down here for 10 years. But it's still good to see that spread and to see there's a reward for a longer investment. And then my housing start numbers, I wanted to show this, but the numbers for October will be released next Thursday. So we'll be keeping an eye on that and be ready to put that number in there and see where we are. Again, I still expect it to go up. As I said before, April and October typically are good months. I expect that to bump up a little bit. Remember, we had a pretty good September, surprisingly good September, and we'll take it from there. So that is this week's market insights. There is a lot to talk about. We're still got to get through some of the chat from the election. We're going to be going into the time of year where there really aren't now a lot of hurdles that we have to face. It's more a matter of, okay, when the election's over, the market likes that. And now let's make sure we're positioned for 2021. Our biggest challenge is going to be interest rates in 2021. The Fed's reconfirmed that they do not expect to change those. So we are here every Friday morning at 9 o'clock. Obviously, we will not be here. We will not be here the day after Thanksgiving or Christmas Day or New Year's Day. Other than that, we are here at 9 o'clock. Invite your friends and family. We hope we can help. We've had a lot of calls here at the office. People want to know what to do right now. And that's interesting because most of those calls are coming from non-customers coming to us, and we're always here to help. That's what we want to do. So have your family give us a call if they want to talk to somebody. We're glad to do that. And there's no charge for a visit to see if maybe we can help. Thanks for being here. If you have any questions, give us a call, 913-259-2110, or email me at mmccauley7821@gmail.com. Thanks so much. We'll see you 1 week from today.